Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading weekend in October 25th, 2024. I'm Preston Brenton. Thanks for tuning in. Well, the theme this week is it a market breather or is there going to be more to come? Let's kind of jump into that thought a little bit as we take a look at where this past week finished up and then what some of the big events are coming up that can really move these markets around a little bit. Um, the S&P finished lower this week after posting gains over the past 6 months. So this is the first week that it dropped that 6-week winning streak. Equities kind of took the same cues from the US Treasury market, right? Futures markets pricing in now reflects a much shallower Fed rate cutting cycle. I mean, the best performer for the week was Tesla. Um, it kind of helped the index from falling further, but on the other hand, Apple pushed the markets in the other direction. Some analysts downgraded their calls on the stock amid lower projections of sales from the new Apple iPhone 16. So now the markets are trying to assess a possible outcome of three big events. We got big tech earnings this coming week. We got the November 5th election, obviously, and then the Fed monetary policy decision on November 6th. So we got a lot of stuff coming up. Next week's big tech earnings, I mean, we got Google on Tuesday, Meta or Facebook and Microsoft on Wednesday, followed by Amazon and Apple on Thursday, right? So big tech this week. Any one of these can move the markets around. In addition to these big tech, we're going to see Visa on Tuesday and MasterCard on Thursday. And then we get the big oil giants, Chevron and Exxon, before the markets open to round out the week on Friday. So a lot of earnings activity coming up, right? And that all of these earnings can move the markets pretty good deal. The Fed Beige book reported little economic growth across most of the U.S. This past week. Remember, the Beige book measures all 12 regions in the United States. It comes out 8 times a year. And the report noted that demand for workers eased somewhat while inflation continued to moderate, although it's still relatively sticky. That last half mile for the inflation coming down to 2% could be a little bit harder than the Feds think. And the 10-year Treasury will climb from a low of 3.58% last September to an intra-week high this week of 4.23% on October 23rd. It settled in to close out the week about 4.24, as you can see on the screen right there. A little bit less than 4.2 or 4.24. But just a real interesting week as far as interest rates go. Now, the market expectations for the Fed rate cuts have steadily ratcheted down. So now the markets are looking at about 125 basis point cuts coming in the next 12 months. It used to be over almost 200 basis points. So that's dropped dramatically. And to me, this climb in interest rates, especially the 10-year, after they started off the rate cut cycle by cutting 50 basis points, it reflects more of a stronger economy, including better than expected job reports, I think, stronger retail sales than expected, and a little bit, like I said, sticky inflation. Also keep in mind that we just finished the 2024 US budget cycle. It ends the end of September, and there's a shortfall of 1.8 trillion, right? That means we got to go to the bond auction market or the Treasury auction market every month to finance 1.8 trillion by other countries and sovereigns and central banks and others from, they got to borrow that money. They got to buy that money, right? And are they going to demand a higher interest rate to buy that debt? Well, we'll see. But that's equal to about 6.5% of US GDP. So that tide of red ink really in the US right now is unheard of, except in times of recession or in times of war. So all in all, it's a really mixed bag in the markets, although we're near all-time highs, right, with interest rates going back up. Now, if you look at the week, you can see the Dow and S&P and the Russell all finished lower for the week. NASDAQ was the lone holdout, finishing up just slightly. I think some of that was due to Tesla. Year to date, everybody's still strong. You can see the PE ratio, I think, is very stretched. The trailing 12-month is over 25. The forward is over 24. That just to me is much higher. Now, understand as long as earnings come in stronger, well, then you can support higher multiples. But with interest rates forecast to come down slower than expected, And we still have some key data coming out, plus the Feds on November 6th. It's really interesting to see how this is going to shake out. All right. 10-year Treasury, the yield of the S&P is at 4.5. It's only 26 bips over the 10-year Treasury. So that means money is almost at a toss-up, and you'll see more money. Remember, it's about a competition where you can earn the most money at the safest risk. And right now, the 10-year Treasury at 4.24 is pretty darn good, right? The current VIX climbed up again over 11% for the week to close it out at a 20 handle, 20.03. Last week, it was at 18.03. So the VIX is steadily moving up just a little bit. It's hanging in there. And I don't think until we get through some of these big events that I talked about will we see the VIX come down. All right. And the best performer for the week was discretionary. You can see there it came in at 65 bips in the green. The worst was materials, 2.66 in the red. Utility still bringing up the pack at almost just slightly under 30% annualized or year to date. Energy is bringing up the rear, but still a positive 9.7%. And of course, if we go across the pond and look at the European markets, you can see business activities kind of remained in contractionary territory. In October, we saw new orders continue to stay below 50. Early composite PMI, which combines both manufacturing and services sector data, came in at 49.7. And that was at 49.6 in September. So anything below 50 is contraction. So it's still not that good over there, this composite combining both manufacturing and services. Two of the largest economies in Europe, in fact, France and Germany, were the main sources of the weakness all across the Eurozone. Meanwhile, in the UK, we got an early estimate from the S&P Global PMI. Their composite PMI came in at an 11-month low of 51.7 in October. Now it was at 52.6 in September, so that's going in the wrong direction, right? New order growth slowed. You can see across Europe, everybody was in the red for the week. Euro stocks, FTSE, CAC 40, DAX, all in the red. In fact, the CAC 40, the French index, moved back into the red again year to date as we're coming up on the last couple of months of trading for the year. Okay. And of course, if we go over to the Asian markets, you see the Nikkei was down 2.8%, still up 13.22% for the year. But the yen weakened to the high end of 151 to the dollar, all right, to down around 149.5 to the dollar in the previous week. And the Japan CPI, which is their leading indicator of nationwide inflation, rose 1.8% year over year. Slightly above consensus, but slowing from September's 2% level. Now remember, Japan wants inflation over 2%. They've been, in a stagflationary kind of death spiral for 2 decades. So they're trying to jack it up. Meanwhile, that makes it harder for them to stop their monetary stimulus because they want money into the economy, right? They're still doing that. And then if we go over to China, you can see China was a lone holdout outside of the US with NASDAQ coming in at 1.17 in the green, right? But in China, just think about it this way. It's all about stimulus. This past week, the PBOC injected a little over 100 billion US into their banking system, and they left lending rates unchanged at 2%. And then the Chinese banks lowered their 1 and 5-year loan prime rates by 25 bips. And that is they want to make it cheaper for consumers to take out mortgages and other loans. So they're trying to pump money into their economy. And then the central bank, on top of all that, signaled additional easing measures in the near term with a potential another cut in the reserve ratio requirement for banks, depending on liquidity conditions. So they're all in on stimulus, and they're trying to jack this up. And China, as a result of that, is up 10.92% year to date. But that's a very weak economy. The real estate sector in China has just imploded, as we all know now. It's just very, very difficult. And then if you look at Hong Kong, the Hang Seng Index there, it's down a little over 1% for the week. Still in the green year to date. Again, with all that stimulus, they just pump it. They're throwing money into it, right? The jobless rate, which I found interesting in China. By the way, they came out and they stopped they stopped including students in their jobless rate, but for their 16 to 24-year-olds, came in at 17.6% in September. That was down from 18.8 in August. So they still have a very weak jobs market. Real estate's killing them. Consumers aren't spending, and that backwashes over to exports in Europe, France and China, or France and Germany, especially Germany because they export a lot. France, Italy as well, a lot of high-end goods. Chinese consumers aren't buying as much as they normally do. So that does back up, right? And it also backs up into Japan because Japan is a big exporter to China, as well as the US, believe it or not. So there's a lot of mixed things going on in the global markets as well as in the US markets. And on top of all that, as I said, we got the big tech earnings this coming week. Some of the majors, Google, Meta, Microsoft, Amazon, Apple. It's going to be a very busy week. All right. Um, so you throw that in with the Fed meeting on the 6th and the presidential election on the 5th. I mean, that is a lot of potential volatility movement in the market. So that's why I think the VIX is going to stay elevated until we get through this to see which way the markets want to go. Now, what I want to do is I want to move over to the charts. Let me just swing it over here like this. I'm going to take you over to the E-mini S&P 500 futures. All right, we'll take a look at that first. Just kind of see how things are coming out there. It'll take a couple of seconds to come up on your screen. But if you look at it, you can see it hit my target point really nicely. And as you guys know, or if you've been following me for a while, these colored bars are very solid support and our resistance points. And normally when if price action moves through it, it generally comes back and finds that bar again, as it did right here, right? You can see we spent literally from September 19th all the way through to November the 8th, 3 weeks just sitting here trying to break through. And then you could see this break that happened on October the 9th. And it ran up and we made new all-time highs on October 17th, right? Intraday at 23.16. And now we've been pulling back ever since, okay? I've got some pullback points that I'm interested in around 5,800 and 5,750. Somewhere in this zone here is what would not surprise me. Keep in mind the 50 EMA is sitting at 5733. I've seen some analysts talking about pullbacks down to around the 5,600. You see this gap over here, which eventually will more likely get filled. But these are support points. That I could see here that the markets could pull back on. You could also see here we got a trigger in the divergence on our MACD that triggered over here on the 21st of October, right at that peak. It didn't make new highs and then it just sold off, right? So we got to watch this very closely to see how this thing is all going to shake out. And then, of course, let me just, I got to change my glasses here. Let's come over here and let's look at NASDAQ 100 futures, all right? You can see here, the last all-time high on NASDAQ was made on, this is the 100 futures, on July the 12th, right? We're not being able to push up here. Now, remember, the NASDAQ 100 futures is really driven for all practical purposes by the Mag 7. They own about, their index comprises over 40% of where the NASDAQ 100 goes. But if we look at the NASDAQ Composite Index, the NASDAQ Composite Index actually did make a new all-time high on Friday. That's why you hear some pundits saying NASDAQ made new highs. Well, it's the Composite Index that made the new highs. Up 24.51% intraday, and then it sold off, right? Up to 18,690.01. The last all-time high was made back over here, along with the NASDAQ 100 futures around July the 11th. So is this going to hold or not? Well, this does show that we got some breadth in here, but not very much. If we look at the, let me just find the equal weight over the SPX, you can see this ratio chart really has been moving down since September, which means the breadth is getting thinner and thinner again, meaning it's being taken over by the big mega cap tech, which really prevents the market from really exploding higher. You need firmer support underneath the market to really support these bigger moves to the upside. And we're not seeing it right now. If I look at just the equal weight by itself, you're going to see here the equal weight did make new highs, but it made new highs on 15 October of 15.33%, but it's been pulling back ever since. And I do see a pullback at least to the 50 EMA. You could see the MACD triggered again, just like the other on the October 21st. So these are just, I do believe over the near term, we should expect some more downside action leading up to the Fed meeting, leading up to the election. At least that's what the markets are showing me at this point in time. And then after the election, remember what happened when Trump won in 2016? The markets were in overnight. They were down 800 points, the Dow. And then when Trump was in and it was confirmed that he was in, the market shot up and it went on a tear from about 17.5 to 23,000 in a very quick period of time. So we could have something similar to that this time too. And then the markets will pull back once it starts to gather its senses and sees what's going on with spending levels and things like that. But this is kind of what I'm seeing here in the markets. Now, of course, if we look at the Russell, you can see the Russell, the last all-time high, and the Russell was made on July 31st as well. So we have not quite penetrated that veil from these highs in the NASDAQ 100 futures or the Russell here, okay? And we're sitting right on the 50 EMA. Should that break, I think the Russell is going to go down more. And I think part of the reason why people were thinking that small cap was going to take off once they started cutting interest rates, because small cap's more affected by higher rates than mega cap, right? It's harder for them to finance debt. But with the forecasting of some analysts, I believe in it as well, that the Feds aren't going to be able to cut as much as what's already baked into the market. That's going to put some downward pressure on the Russell, right? So I can see that right here. And then, of course, if we look at the Dow, like the S&P, has made recent new highs. The all-time high in the Dow was made on October 18th. But you can see the divergence cut here in the MACD as well, telling us we're going to get a little bit of a pullback. And like the S&P, there's a gap to be filled slightly below the 50 EMA. I could see some pullback in this as well, right? So I see the odds favor a little bit of a pullback into the election. I don't think it's going to be too egregious. I don't think it'll be too bad. You should use it as a buy-in opportunity. And if Trump wins, then I would go long. Clearly NASDAQ, that would be a favorite. And there are a couple that I told our members you should go long if Trump wins. If he loses, there's some that you should short, or if Kalama wins, you should go long. Okay, we'll review those stocks again for our weekly market watch Sunday evening. Of course, if we look at the volatility skew, if we look at the front month skew comparing the VIX to November, you can see here we're like right on the edge, precipice. We're kind of in the red. That tells me we're in a backwardation environment. That means the VIX is higher than the front month volatility futures, which is not a good sign. That shows a little bit of fear in the market. If we look at the back months skew comparing November to December, you can see here we're much further in the red. So that is telling me that there is a lot of fear going out to the end of this year. That tells me the markets are starting to set up for a possible bigger downdraft in November going into December. Okay, so we'll see how that shapes up. But again, the markets are telling me that we should expect anywhere from the all-time highs of 3 to 6%. We're only down about 1.5% right now. So that would say we got another 2 to 5% to go to the downside. That would be kind of my take right now on what I'm looking at and what I'm seeing. And if we look at the bond market, well, guess what? The lower the bonds go, the higher the interest rates go. This is the 30-year bond. We broke that upsloping trend line. We did a retest of it, right? Right here, we retested. We failed. We broke that level there at 119.14 ticks. I said, if that breaks, it's going to go lower. We'll probably test that, but I do believe any rally here is going to be sold off for the interim, and we're going to go a little bit lower. And that, my friends, will move the 30-year bond interest rates higher, okay? If we look at the 10-year Treasury note, you're going to see here pretty much the same thing. We broke the upsloping trend line. We had a little bit of a retest, and now we're down again. And again, the lower this goes, the higher interest rates go. Now, my system is showing a calculation of a possible reversal of this going into the end of the year, showing interest rates going back down again. All right. A lot of this is going to depend on November the 6th and what Boom Boom Powell has to say, right? The charts are suggesting that the 10-year rate is going to go a little bit lower and then start to stabilize. I mean, a little bit higher and then start to stabilize and start going lower. Their 10-year rates, right? So that's kind of what it's telling me. And then, of course, if we look at currencies, the dollar was up on Friday. In fact, the dollar's been up dramatically. Look at this. The dollar is up because that shows the ramifications of the Feds or the markets forcing the Feds to cut their total number of rate forecast to be less than what the markets are saying, right? I just think the Feds are going to end up cutting the rates a lot less than what's already built in. Okay, they've already cut it a little bit. They're going to cut it even more. But you could see the big, massive move in the U.S. dollar. And then, of course, if we look at the euro, it's going to be just the opposite. The euro is just completely blown through and gone back lower here. I want to see a capitulation down here and then a possible coming down around the lows that we had back over here in the summer months. And then I'd be more interested in looking at a long. But right now, as I showed you with the economic data out of Europe, PMIs coming in at 49.7 in October. That's in contraction territory. France and Germany being some of the worst offenders. And those also happen to be the largest economies across Europe as well, not counting Great Britain, of course. Okay. And in Great Britain, as I mentioned earlier, the PMI came in at an 11-month low of 51.7, the composite PMI of both services and manufacturing. So this does show this may have some ways to go to the downside, the dollar to the upside. Meanwhile, the Japanese yen looks like the Bank of Japan is slowing down their take on reversing their monetary policy or normalizing it, which means they're going to keep stimulus out there, which means they're going to the yen's going to come back down lower, which is great for us. Remember, we got in long the yen back over here, and then away it went. It's going to come back down here, give up a lot of it, and we're going to look at going long the yen again. At least that's the way I'm looking at it. It's been a good trade for us. Of course, gold, well, gold just keeps pressing higher and higher and higher. You can see gold here is near its all-time high that was made on October 23rd, right, this past week at up 33.83%, 2772. I believe gold is going to see 3,500, possibly 4,000 in the next year and a half or two, primarily because of the U.S. budget deficit. We're just spending money like drunken sailors, and that's going to have to stop. If that does stop, or you see the government start to really cut spending, it's going to really, a lot of this money in gold is because of that. You're going to see gold come back down really hard. There'll be days where gold is down 50 to 75 points. All right. But for now, no. And our big trade was the pair trade. I suggested go long silver over gold, and you can see silver is just taking off. Down in this area down here, I was saying go long silver, short gold, and then the ratio of silver to gold, silver really played catch up and then just drove it home. Made good money for some of our members. It was a really good trade. I think it's going to settle in here for a little bit until we get through the Fed to see what the Feds are going to do. Okay. Then finally, if we come and look at the energy markets, if we look at oil, oil is up a little bit. The fear premium with Israel going into Iran, but it really hadn't moved it that much because the markets just, they're not necessarily yawning on the Middle East tensions, but they're saying we don't see an escalation. Otherwise, oil will be back up over $80 a barrel. Oil right now is still below the 50 and the 200 EMA, and the 50 is below the 200 EMA. So that does suggest oil is going to settle in at a lower rate. Remember, OPEC wants to add more supply to the markets in December, about another 100,000 barrels a day. And the supply is outstripping demand right now. So that tells me that oil is going to run steady to slightly down. And short of any fear premium in a barrel of oil for the Middle East stuff, that's where I think oil is going to stay, down in these lower levels down here. Okay. And then, of course, if we look at nat gas, it's any rally here is going to sell off. I'm looking at nat gas to come back much lower, back down this area here, and then we're going to look at going long again. So that's a little bit about a real quick overview of the markets. I do believe the markets in net are going to be pulling back, or the odds favor a pullback. Doesn't guarantee it, but the charts favor a pullback over leading up to the November election on the 5th, and then the Feds on the 6th. So And we got a very high bar for all these big tech earnings next week. So I just see any upside is going to be limited. The bigger moves, I think, are going to be downside action. All right, everybody, that's kind of where we're sitting now. Enjoy the weekend football. Members, I'll see you Sunday evening for our weekly market watch. Ciao, folks. Take care.